This session is concerned with venture capital, and we're going to start by looking at the definition of venture capital. Now, this is an important source of finance for new companies, particularly innovative companies, perhaps companies introducing a new product or perhaps varying their production technique. So traditional sources of finance, perhaps the banking system, is not necessarily suitable for those companies because of the higher degree of risk, or because there is a general lack of knowledge about what is happening within the company or what the company is doing, or perhaps even the direction it's been taken in. So venture capital solves an important source of finance for economic development, for business development, and it enables innovative companies to pursue projects which perhaps otherwise would have not seen the light of day. So generally speaking, innovative companies engage in high risk investments, and with the higher risk they require specialist sources of finance. Venture capital is used to finance these investments, and this is raised in the capital market by specialist venture capitalist companies. So venture capitalists buy shares or convertible bonds in the company. In other words, the venture capitalists take a stake in the company. They supply the finance, but in return they take a share of the business. They allow time for the company to expand and develop, and then they liquidate their investment. Obviously, if the business is highly successful, the share they've taken will have appreciated in value and they will make a profit. Of course, it's also possible that the company will not prosper. Perhaps the idea was not as good as people thought, or whatever, something happens in the market, something adverse, so that the venture capitalists would incur a loss. So they are taking a risk, but they're doing it in this particular form. They are particularly interested in innovative SMEs, small to medium-sized enterprises. And they are particularly interested in very rapid growth rates. Generally speaking, they like to, once they've made a decision, to put their money in, take a stake in the business, and get their money back. The payback period is short. Get the money back, get their investment back as fast as possible. That's the preferred route. So let's look at the issues here with the finance. Well, we have equity financing, buying a share in the business, and its drawbacks. So taking equity share means losing part of the ownership of the business. So the people who set up the business in order to get the finance to get it started must accept loss of some aspect of the business, some control perhaps of the business. So the business owners lose part control of the business at least. Generally speaking, the shares are not secured. Generally speaking, the venture capitalists, if they like the idea, will issue the investment required on the basis of the idea. Perhaps they like the idea, whereas perhaps other forms of finance may require the owners of the business to put their house or some personal assets to secure the investment. But they may require a directorship. They might want to sit on the board to make sure that what was agreed is being pursued. So they want to know what's happening on the inside. Shares are unlike a loan in that no interest has to be paid. So generally speaking, equity financing, there is no interest payment. What happens is there is a dividend. The company will issue a sum of money per share, perhaps every year or every given time period. And that means the business has more flexibility. It's not honor bound to make a fixed payment at a certain period of time. It has got flexibility about when it issues the dividend and the extent of the dividend. Of course, if the venture capitalists were to have a director on the board, the company's expenditure will be fully scrutinized, and it'll be obvious to the venture capitalists what the policy of the business is and how well the directors are meeting their commitments and what they promised at the outset. The venture capitalists will bring experience and a fresh perspective to the business. Well, venture capitalists have wide experience of startup businesses and new and innovative businesses. So it is a good thing that the venture capitalists are involved in the business. But as I said at the outset, the profits must be shared with the venture capitalists. We don't get something for nothing. So the business is getting the investment, but it must share the prosperity with the venture capitalists.